Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. This week on the podcast, it's another chance to have a conversation with Peter Hewitt, the recently retired manager of the CT Global Managed Portfolio, who is now pursuing his active post-fund management career as director of a couple of interesting things, including the AIC and Addition, the Investment Trust. And we will be looking forward also at the end of the podcast to the important clash between Scotland and the All Blacks and the fact that Scotland have never beaten the All Blacks in history. But this could be the big moment. It always could be the big moment, but this is the big moment we're going to be talking about at the very end. But before that, let's get on to the far more mundane subject of the global financial markets and investment trusts. Last week we had a kind of good risk-on week for equity markets. This week, it's all gone into reverse. NASDAQ is down significantly and so on. And all equity markets basically are down apart from Latin America and one or two other smaller markets. And meanwhile, gilt yields have edged up a little higher this week, particularly at the long end, after a good run. So, Peter, in the big picture terms, what's going on?
Well, I think a pullback was definitely probably needed, Jonathan, because markets, particularly in the US, but in the UK and Europe as well, had really pushed on over the autumn. And so now some reality is coming into the situation. In the UK, clearly we've got a budget which nobody is really looking forward to. I'm making no comments on that, but I just think that we need to kind of get it out the way. And there's likely to be bad news on taxes, probably more personal than corporate. But once we know where we are, then markets begin to price that in. What will it mean for growth next year? Markets will begin to price that in. And I think from that, we may get the opportunity to move forward. I think also within markets, the re-emergence of the FTSE 100 leading the market again the last month, 6 weeks, and the 250 and small caps lagging has not helped overall investment company performance or indeed discounts, which are no longer coming in and if anything will be edging out. So that's in the short term. And in America, simply put, a huge run in markets. It was definitely time for a sell-off and a pretty decent quarterly earnings period from most of the big tech companies has been met with, right, we're taking some profits here. And I must be honest with you, it's just a valuation issue. I think the fundamentals are still quite well placed. So in the short term, I think that's kind of where we are. We're in a holding pattern at best.
That would certainly concur my thinking. I mean, you're right about, I think, the UK budget. Clearly, when Rachel Reeves went out this week and made his speech, obviously preparing the ground for either breaking the manifesto promises on tax or other kind of tax increases. Now, we know how these things are always managed, so you could argue that both ways. I've seen both arguments put forward. One is that just rolling the pitch so that everybody is not taken by surprise when the tax rises come. Another explanation is that they're trying to paint it as bad as possible so that when it actually comes out, it's not quite as bad as people feared at that stage. But it's interesting you say that small caps have underperformed significantly over the last few months, which you would think would imply that maybe the markets have been fearing a repeat of last year when businesses were sort of clobbered directly. But in a funny sort of way, maybe the impact on personal taxation might actually be more damaging for a lot of sectors than the corporate one, where obviously corporates adapt, and they have adapted in the past 12 months to the national insurance increases and so on. But if people stop spending, then that's going to have quite a ripple effect. It's already being visible, I think, in the housing market. It's very interesting. My daughter is in the process of trying to buy a house in London, and everything is being discounted, basically. It's suddenly a market where you can buy something as opposed to not being able to get there. So we could be in for a relatively tough time. And of course, the Bank of England is making noises as well, which aren't particularly helpful. So, as you say, let's get it out of the way and see where we go from there. Do you think that small cap, though, at this point, given that, if you like, some bad news has been priced in, I think, to the performance? I noticed this week that Alex Wright, the manager of Fidelity Special Values, was saying he's been starting to put money back away from FTSE 100 into small cap stocks. And I think you've spoken to a small cap managers, one or two recently. Do you think their mood is now more positive, that actually they should start to get the performance back now?
Well, I think the professional fund managers and Alex Wright at Fidelity and other specialist UK small cap managers are beginning to become quite attracted to the valuations that are on offer. I mean, there is still risk, and you mentioned the budget, and I think consumers are actually reasonably well placed in the UK. The savings ratio is much higher than normal. And although unemployment is showing signs of increasing, it's not really significantly so. And if we got some interest rate cuts, that would be helpful for the housing market and helpful for individuals. At the moment, they are kind of not, they're in the vortex of this negative publicity to do with personal taxes in the budget. But looking out to next year, once things settle down, I could see actually things beginning to improve. Not a given, but that would be important for the small cap sector. Underlying that, Jonathan, you've got quite a lot of M&A happening. And the fact that is happening is telling you that valuations of smaller and mid-cap companies in the UK remain quite depressed, particularly in an international context. And so that's a positive. And, it's funny, these sorts of things, however negative sentiment may be at the moment, things can change relatively quickly. And the starting point for that big slug of the market is that valuations are genuinely quite inexpensive. And you've got a lot of potential there, but it's the consumer. So for pub chains, restaurants, hotels, housing, retailing, all of them, lots of small companies there. If the consumer was to just close that wallet, put it in the back pocket, that isn't great. And we've got to see them be more prepared to step forward. And if that happens, then despite what's going to likely happen with taxes, you could actually see quite an improved climate next year for the small and mid-cap sector.
Yeah, well, it is interesting looking at some numbers. I just read out some numbers about performance year to date. According to my data set anyway, the all share is up around 16%. FTSE 100 is up a bit more, which is extraordinary. Fidelity Special Value just mentioned that. That's up 26% this year. This is just the share price, not the total return. But then you look down the list of the small cap trusts and they're way, way behind. I mean, we've got JP Morgan, UK Small Cap Growth and Income, a very experienced manager, that's up less than 5%. Addition, the one you're on the board of, is up 6%. But they're the best of them, really. And you go further down, you're looking at well-known trusts such as Aberdeen, UK Smaller Companies Growth Trust, that's flat, essentially. Aberforth, up 1%. Montanaro, BlackRock, smaller companies, they're all actually down year to date. I mean, this is an extraordinary divergence between the two types of stock. And we were all thinking a year ago that small cap, we'd hoped to have a revival until the budget came along anyway. So taking a kind of long-term view, as I think you and I can do, even our grey hairs, that potentially is quite an interesting opportunity, surely, as you've been saying.
Yeah, I think you're right. And I think it's where you've kind of got to put your brave vest on if you're going to consider and just, genuinely keep your eye on the medium to longer term, because you'll never get the bottom. And some of these managers, JP Morgan, UK Small Cap, Georgina Britton is really experienced, a very good stock picker. Although I'm horribly biased, I would say exactly the same about the Odyssean Trust, but there's one or two others there you mentioned are in that category as well. And they'll find the winners when things change. But at the moment is a headwind, and it's uphill and into the wind for UK small cap. But you look at discounts of some of these trusts, and double-digit discounts are now back in fashion. And so picking up, I don't know, Aberforth on a 10 or 11 discount, same for the JP Morgan Trust, that strikes me as being not a bad and interesting thing, Jonathan, is for a lot of these trusts, they are geared. And that tells you the manager is finding what they consider to be attractive opportunities. Now, of course, could all go horribly wrong, and we could be in a recession quite quickly. But when experienced managers like that are prepared to gear us, I mean, Mercantile, I think, is another one. That's a mid-cap specialist, and it's quite highly geared. I think Lowland is too in the UK equity income sector. It's got a big weighting in mid and small cap. That tells you they're finding value, they're finding good companies, decent balance sheets with decent profits growth, which are just unloved. And I think what you don't know is when it's going to show through in terms of the share prices, but I'd like to be there because it can happen quite quickly. And so, yes, I think that is an area which I think could do better. And just contrast that for a minute to, say, the US, where you've got some fantastic companies, and in the long run, you want to be exposed to some of these. But there's no doubt that however exciting some of the big tech companies and other companies are, when you've got rating forward PEs 30 and 40 times, it doesn't take much for you to experience a very sharp and painful pullback. And so just mind your eye. I mean, in the long term, if I was a global manager who had a decent chunk in America, I would be gradually reducing that, not selling out, far from it, but just gradually reducing, because the real upside isn't there. I think it's in UK and Europe, possibly even emerging markets.
Well, let's talk about emerging markets briefly, if we may. I mean, they've had a pretty rough time until recently anyway, until this year. And yet we just had this redemption opportunity at Mobius Investment Trust, which is a specialist emerging markets trust, has to be said, a small-ish. And more than 40% of the shareholders opted to redeem, which I think is interesting, despite the fact that, as you say, many people think that emerging markets are the place to be and have done pretty well this year. So what do you think is going on there? And if you look at emerging markets, how do you personally think about the best way to get some exposure in that area?
Well, in the case of Mobius, I think it's an interesting one. They are quite different from almost the rest of the emerging markets sector within investment companies because they are specialists in smaller companies. And that's not been the place to be in emerging markets. Some of the trusts that have typically got big weightings in TSMC, Taiwan Semiconductor, or Tencent, or Alibaba, even Samsung, have done much better. And that's partly the technology element of it. They're bigger companies. They drive the MSCI Emerging Markets Index, whereas the smaller companies just don't. I think also Mobius is probably underweight in China, which has been quite high risk, but it has been the place to be. Now, personally, I like the Mobius approach, and I think in the long run, that will prove to really deliver some interesting returns. But it is disappointing that, over 40% of the share capital opted to redeem at par. I think it was on a discount of, I can't remember, 8 or 9, somewhere round about there in the run-up to that. So, yep, opportunity for a very short-term uplift. But in the longer run, it's a research-driven trust. They do a lot of due diligence and they find names that's not really available anywhere else. And I think has a lot of interesting upside. I hope it continues. But the broader emerging markets, which are invested, trusts like the Templeton Trust, JP Morgan and the like, will be invested mainly in the bigger companies. I mentioned the big tech companies and the likes. They have done extremely well. And so maybe that will continue. It wouldn't surprise me if I did. Ratings are certainly cheaper in emerging markets, clearly, than in America. But I really feel the play again is in the mid and small cap area. And I'd definitely be holding on to Mobius or even looking to increase it. And it will be interesting if the more general trusts begin to shift away from the bigger companies within the emerging market universe to maybe some of the mid-cap opportunities.
Yes, just looking at the AIC numbers now, the average one-year performance for the emerging market trust is 35%. So it has been a pretty impressive recovery. And also, I thought interesting from a sort of technical point of view or from an experience point of view that everybody said we're going to reduce our US exposure, the dollar's going to come down and we're going to go into emerging markets. But despite that being a consensus view, it's actually happened. And that's not always the case, is it? You see a consensus view and it doesn't happen quite often.
But the thing is, emerging markets have seriously underperformed for a protracted period. So they were due a rebound, and they have. You've just outlined the numbers, and that's encouraging to see.
But on that other point of gearing, it's interesting that very few have got much gearing in place at all, which is maybe telling you something about momentum anyway, if nothing else.
Well, I think, when I met fund managers, you would often ask about gearing, And of course, most of them would say, oh, that's the board's decision. But the board will be driven by what the fund manager thinks. And where you come across fund managers, and you can read it in the annual reports, interim reports, sometimes even fact sheets of companies, where an increase in gearing has been due to, oh, we're just finding lots of opportunities at attractive valuations in our universe, particularly if that's an experienced manager who's delivered good returns in the past, that's always a positive. Now, they don't know quite when it's going to start performing, but I do think that's when you really want to back certain trusts, particularly if they're at wider discounts. It's happening in the UK space, and it's interesting in emerging markets, you're noting it's not happening. So we will see going forward.
Just taking another step back and looking at what's going on in the context of the great debates we've been having about how much, how far and how fast the universe is going to shrink because of consolidation, because of the wide discount problem and so on. One of the more, I think, sort of compelling arguments that you do hear, one which I would certainly subscribe to, is that the trusts that are going to survive are either the very large, long track record, proven performers on the one hand, or there are trusts which are, as we say, taking advantage of the investment trust structure to do something that is different from other trusts. And that doesn't matter if they're particularly small. So we don't necessarily want to lose these smaller trusts, the likes of Mobius in that case, or other specialist trusts, something like River UK Microtrust. That's a kind of specialist thing that have a concentrated portfolio, do use gearing when they can, and so on. We want to keep some of those alive, do we not?
Definitely. And I think actually that is where you will get some exciting performance. Take the biotech trusts, which had really not performed, and they've had a great last 3-6 months. And you can come across some more almost sector-specific trusts. Biotech's a case in point. I mean, I listened to one Ecofin Utilities Trust, Global Utilities, actually a really good record. It's at quite a wide discount, lower risk than in some areas. And that's the only one that's offering that type of exposure to you. And they've got serious resource and good due diligence behind the stock selection. So there are certain areas where that's where trusts sit sort of 200, 300, 400 million, I think have a big role to play, particularly for retail shareholders who are wanting to have some core holdings, maybe in global trusts, UK trusts, but have one or two kind of satellite positions. And there's some biotech, utilities, technology, small caps in Europe, for example, is not one that immediately springs to mind, but my word, you've had some quite interesting returns there. So, yeah, I think they have a genuine future. But like everything else, if discounts get wide and persist at being wide, then our friends at Saba and others will move in to try and take advantage of that.
Well, let's talk about Saba, shall we? That seems a good moment. We've said several times this year in conversations, certainly on the podcast, they definitely haven't gone away. They didn't win their votes at the start of the year. Perhaps they never expected to. We can now maybe think that, but they've got a lot of publicity and I think are actively raising new money and will be coming again. And they have disclosed some new positions, which is interesting. One is they've disclosed a 6.2% shareholding in Diverse Income Trust, which is an interesting trust that is, again, does something that I think not many other trusts do. We might talk about that one. And they've also taken a 5% position in RTW Biotech Opportunities, which is an interesting one of the biotech trusts that is still on a big discount despite the surge that we've seen in biotech. I think it's still on a discount in getting on for 20% or mid-teens anyway. And they've taken a big stake there. And they've also increased their holdings in some other trusts, including Smithson, Impacts Environmental Markets, and Life Science REIT. And in addition to that, also, they've come back again to take a stake in Montenero UK, which, having sold out completely or had their shares bought back, they've come back for another bite of the cherry. So they're definitely still around. And as you say, they've become a significant factor in the way that we think about what's going on in the market now. Is that not fair?
Well, they sure are. And yeah, it's interesting, some of the more recent moves. I mean, likes of Diverse Income is not a trust that has had dreadful performance, or in it. Yes, it has lagged on a 3 or 5 year view. And that's because 2/3 of its portfolio are in mid and small caps. And it's in a sector, UK equity income, where a lot of trusts there have got big holdings in FTSE 100 companies. And so they will have done better. I mean, diverse income has actually had a better last year, but it also has got an annual redemption facility, which may have been a good idea at the time of launch. And there's a few trusts who've gone down that route. But actually, it can be a double-edged sword in more difficult times. And so I think Diverse's discount was maybe only 8, 9, I don't know the exact number, but you could buy that in the knowledge that actually 9 months down the road, you'll get a redemption opportunity at par. And so unless Diverse changes that somehow so that that's not on offer, you're opening the door to people, it may be 5, 7%, 8% sort of uplifts, but that will be taken by activists. And having a yearly redemption, you would have thought, would have closed discounts on that particular trust, but it hasn't really until the very last minute. So in the case of diverse income, the danger there is Saba just holds on and will redeem its 6% position, or it may be a bigger position, who knows? I think also it's interesting, Saba definitely moving into the alternatives area, Jonathan, and you mentioned life sciences, REIT, Workspace, Gore Street Energy, and I mean, I'm not quite sure how they're able to do that, but if they are able to have some sort of tender in these trusts, or even they may try and liquidate them, then who knows, they might be able to make quite a tidy sum because discounts remain wide in quite a few of these areas.
It might be worth reiterating the point about Saba and that they are essentially an arbitrageur rather than, if you like, just a discount player. Perhaps you might just remind some listeners who aren't particularly into this what that means. So in terms of how they guard against market movements and so on, how they hedge their positions, and how they might be doing that in the alternatives area where it's obviously much more difficult.
It is a lot more difficult, and I'm not sure how they would achieve that. I'm afraid I'm not good enough to know that. But when it's an equity trust that they are buying shares in, they will definitely endeavour to offset the risk of the asset value going up or down by having a hedge on the underlying holdings. Now, I mean, it's a moot point. How can they achieve that with the likes of Herald, which is one of the first companies? They've got a 29% stake. It's UK, US, European small cap technology companies. It can't be easy to get a hedge on that. It might be quite expensive, but they obviously have that. And they've got Baillie Gifford US Growth, Edinburgh Worldwide. These are not big company portfolios, but they've gone and they've taken big stakes there. Some cases, both Edinburgh Worldwide and Baillie Gifford US, there's about a quarter to a third in private companies. How do you hedge that? I'm not sure, but it hasn't prevented Saba going ahead with this, and that's what they're seeking to do to offset their risk. Meanwhile, hopefully through their shareholding, and perhaps triggering a mechanism whereby there is a tender, share buyback, or even a complete liquidation, they will get the uplift between the wide discount and the final asset value. And all of this happens, the root cause are wider discounts. But in the case of diverse income, I don't think the discount did get that wide, but the annual redemption, which is well known, as operated for a number of years, offers the activist the opportunity to get a close in that discount and the uplift when the annual redemption occurs. So it's a tricky one, and it still offers opportunities for the likes of Saba.
Yeah, indeed it does. And it's interesting that they are, as you say, expanding their kind of exposure. I just wonder whether in some cases they might actually be taking, if you like, a value view rather than just an arbitrage view where you're trying to eliminate the market risk and just take the discount movement, which comes either from naturally because of demand coming back or because they're on the register, and not just necessarily relying on the board actually doing something to give them a chance to exit. Interesting. I don't know. They're not sharing that information, of course, at least not with me. You are listening to a Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. On the content of discounts, you mentioned they've widened out this week, and they have quite significantly, actually, gone from about 13 to 13.7%. So back to the kind of 14% level, which has been where they've settled a lot of the time, trading in that range. But one of the big factors there, of course, has been what's been happening in the renewables sector, where the bad news goes on, or at least apparently the bad performance goes on anyway. And this week we had another reason emerged for that, for the discounts widening again and for NAVs to be marked down. And that's come from the government, which has basically said it's reviewing the subsidy regime and is looking at changing it ahead of the previously announced period when it will end, which is in the next decade, 2030s. So what's going on there, and why is that so significant?
Well, yes, changing the subsidy regime is not good news. And they're changing it in the context as they hope to move from an RPI-linked payment to a CPI-linked payment. Now, that was due to happen in 2030, and I think what the government are keen to do is bring that forward to 2026. Now, that will reduce, because CPI tends to be roughly 1% or so less than RPI. So that would reduce payments to renewable companies and the contracts that they have. And so that then feeds through to what the asset value is. And you have to sort of bring forward a number of years' payments, you discount that, and then it ends up in a reduction in the asset value. And that will happen across the board if this comes to pass. Share prices move ahead of this. There are already sentiments pretty negative in that sector for a whole series of reasons that, Jonathan, we've touched on in various podcasts. So until, I guess, the market gets confidence that net asset values are stabilising, and not with one reason or another falling. I mean, over the summer it was low wind speeds, which actually does affect in the very short term, but it just seems like one thing after another. And my own feeling is that the key is, does it affect the dividend paying ability of these trusts? Because if it does, then I think you've got a serious problem. And the way the share prices have been moving, the share price of Renewables Infrastructure Group, the yield there is over 10. I think in Greencoat UK Wind, it's probably not far off that. And these are some of the better companies. And Bluefield Solar, which is not one I know that well, it's maybe undergoing some sort of corporate reconstruction or potential liquidation. But that was on a potential dividend yield of nearly 12. Now, when it gets to that level, the share price is telling you there is a big risk to that dividend. And so I think that one of the key factors within influences on the share price in renewables will now become dividends. Can they be sustained? And so it's been very unfortunate, but the news just keeps getting worse in that area.
Well, it's interesting. The consultation that's come out has put forward two different ideas. One would significantly be worse than the other. So they haven't yet said which of the two they're going to pursue, and they put it out as a consultation, so they'll get a lot of feedback, which I dare say will say that the second of the option, I won't go through the technicalities here, but basically, according to some of the brokers' notes I've seen, option one would have an impact somewhere between 0 and sort of 3-4%, depending on the individual trust and what its profile is. But option two would be much more dramatic, would have an impact of 9-10% on the NAVs. And as you say, crucially then, affect the yield, because you always say, well, at least we got the yield. When you invest in these things, we've been saying almost since they first started, you're getting a handsome yield from these things, and it's guaranteed because of these subsidies. And therefore, it's worth taking a bit of capital hit because you're getting that yield. But now, if that prop's removed, then a lot of people are going to say, well, why on earth are we owning these things at all? And the other point I guess you have to make is, well, this again seems to be an example of the government which always seems to be doing things which are in conflict with itself and its own objectives. In other words, we've still got the net zero ambitions, Ed Miliband and so on, though they appear to be being modified slowly. But also a government that's committed to growth. And this is one of the areas which is going to produce growth by more investment in renewable infrastructure and so on. So it's a bit strange. It just seems that, yet again, they've got things pulling in two different directions. They want growth. On the other hand, they're doing things which are going to inhibit it. And that's not a very good combination, shall we say.
It's not a good scenario, Jonathan, and share prices have reacted by moving to apparently very wide discounts. 30%, 35%, 40% in some cases. But that's where you start saying, well, but is it really a discount of 35%? Or actually, is the market saying, listen, this NAV is going to come down quite sharply, and actually the discount might only be 20? And so when you have uncertainty over where the asset value is and all of this stuff, I have to say that's where the dividends is the one sort of flag in the ground that you can say, well, that's the reason I'm holding this. And so if there's starting to be questions raised over dividends, there may not be. I don't know, but there's a fair bit of debt in some of these companies. And ultimately, that also comes back to there's a day of reckoning there. Then it's a difficult one. So, yep, you're right. Government policy does seem to conflict with itself sometimes. But the nub of it for renewables have been they've been in not a good place to invest now for really quite a number of years. And I think the next step is corporate activity. And the way that would tend to happen, I think, is asset sales, sales of the entire company, maybe the case in Bluefield. And if that's the case, at what level? Is the asset value realised? Or is it actually a significant discount to the asset value? Not sure.
The absence of M&A activity or corporate activity in that sector so far, and among the big boys, the bigger trusts, has been the dog that didn't bark, right? I mean, because we've seen it happen in other sectors, saw it happen in commercial property to a significant extent, and to a lesser extent with things like BBGI, but it just hasn't happened in this sector so far. And so maybe the people who are in this business, they do actually have a question mark over those NAVs, and if you like, the whole regime. And if the governments, meanwhile, are changing the regime, that doesn't help at all, adversely. That is not a good combination. So it's all quite tricky. I was going to mention one other thing about Saba. I didn't mention another trust in which they've just announced a significant stake, and that is Schroeder Real Estate. We haven't really talked about commercial property more recently, and that is going to be interesting because that's one of the last, at least semi-diversified trusts out there. We've lost most of the rest of them. And it could be, I mean, we are getting to the point where we have to say whether the commercial property sector of the investment trust universe is, well, is there one?
It's shrunk massively. And you're right, the Schroders one is one of the last few diversified trusts. Okay, Life Sciences REIT is a specialist vehicle, Workspace similarly, but they're clearly now moving into try and capture upside from very wide discounts. And Schroder Real Estate is a case in point. It's not been a badly managed trust, but real estate has been out of favour for some considerable time. And you just wonder, we were talking about how on earth does Saba manage to hedge out its exposure here. But Jonathan, you raised it. Maybe they're just saying, well, actually, this discount and the potential for commercial property, which has got some upside in it now and is probably better placed than it's been for some time, we're just prepared to take that risk and try and actually bring about some sort of corporate activity which will mean we can realise at a significant upside to what we've currently bought in at. I mean, Schroders now discount, I see, is only 12 or 14. There's still some wider discounts, mainly of kind of specialist vehicles, but it's interesting that they do see upside in that. So we will see.
We certainly will. So I think we're getting pretty much close to the end here, Peter. So we've had a good thrash around the financial markets and the investment trust world, which is always is full of interest and lots of significant things moving, going up and down. So it only remains to tackle this important subject, the one I mentioned at the beginning, which is the rugby. I was looking up the figures, and I think the stats are that Scotland versus New Zealand played 40, drawn 2, lost 38. I mean, this could be the moment when they start teaching this in Scottish schools, in Scottish history lessons, the year that Scotland beat the All Blacks. So is it going to happen?
Well, now, Jonathan, I will be amongst the 70,000 pilgrims that go to Murrayfield tomorrow in the hope that some miracle happens. I'm minded that I actually played against the All Blacks, but not for Scotland, for Edinburgh. And we played them on a Tuesday afternoon in the autumn, and we lost 23-16. not a bad result. Nowadays, if Edinburgh were playing the All Blacks, it'd be 123-16. But that Saturday was one of the two draws. It was 25-all. And it also came just after a British Lions tour, and it also happened just before a Scotland Grand Slam, that coming Six Nations. Now, Jonathan, far be it from me to predict either of these things, but we live in hope. But I have a feeling if you were to play the odds, an All Blacks win wouldn't be a monster surprise in the great scheme of things. But you never know.
Well, according to the BBC, it is a 120-year record, so this would be quite a moment if you managed to pull it off. What do you remember about that particular game, though? Were they fielding their best team, or were they fielding their sort of second team? But they were still pretty large and pretty aggressive, I imagine, with them.
Yes, all of those things. Extremely organised. But as I say, it was 23-16, but that was an amateur game then, and so things were quite different. Now it's a professional game, and the All Blacks are supremely well disciplined. They beat Ireland reasonably comfortably. I think they've got England hoving into view the week after, and they're probably viewing Scotland as a relatively easy week for them, and history would say they're probably right. The last time they played, it was 22-19 for the All Blacks, so it was close. I have to say, I think it probably will be relatively close, but you'd have to favour the All Blacks, Jonathan. But I'm sure the Investment Trust shareholders and interested parties listening to this will probably roll their eyes and think, oh my word, there's no chance of this. The All Blacks will win by a barrel load. But who knows, Jonathan? Who knows?
Well, hope springs eternal indeed. Meanwhile, I have to say, for those of us who support the team in white, things seem to be going quite well as well at the moment. So we'll see how they get on as well. And of course, I've just double-checked with the BBC, and everyone still likes to believe what the BBC knows what it's talking about, despite some evidence to the contrary that came out this week. And it actually is only, I think, 32 matches you've had and 2 draws and 30 defeats. So my apologies, I over-egged it a little. Very good. Well, I just round off by saying that this week also I sent off the final proofs of the latest Investment Trusts Handbook, which regular listeners will know comes out every year in the first couple of weeks in December. I sent it off to the printers this week, so it will be coming out shortly. If you're interested in that, you should be able to pre-order a copy. The hardbacks will cost you a few pounds, but there will, as always, be a free PDF version. Depends really whether you want to keep this as a reference work on your desk or something else. But anyway, you will find comments from Peter, amongst others, in this year's edition. We've got quite a lot of interesting themes coming through. There's a very interesting article about how you, personally, as an investor, be you ever so small, if you like, as a private investor, could use AI to help your research. And we've got the usual series of features, including a forum of leading fund managers and analysts. And this year also, for the first time, a forum in which I ask 4 chairs of investment trusts their thoughts about what's been going on in the sector and how far they should be and are mobilizing to try and tackle this wider discount issue. So plenty of meat in there. I would say that, but I hope you'll agree when you actually see it come out, which will be very shortly. So thank you all for listening. And of course, thank you, Peter. We'll look forward to having a post-mortem in a few weeks' time.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.